there are many types of credit challenges one can experience, no pun intended. If it is, what is some key elements to helping people to get back on track with their credit? Some simple things we can start doing now.
First thing is taking ownership of it and acknowledging it. It is much easier to tackle those hard things as soon as you decide to get started. I do believe some people believe that if we just ignore it, it might go away, but we all know that that is not the case. So just acknowledging where you are, understanding your credit report, and being able to set a budget to start to tackle any areas that need a special attention.
Excellent, excellent. And Rod, when it comes to buying a home, you were mentioning, or when we were speaking earlier, that certain things are changing related to credit scoring, what are acceptable credit scores. So now, is it easier for people to meet the credit challenges or credit standards of lenders? Harder? Give us an update as to what's going on in that area.
Yeah. Well, recently, Fannie Mae and Freddie Mac, who are the government-sponsored, and the GSEs, they call them, that underwrite mortgages on the secondary market. So get into kind of technical terms, but if you get a mortgage loan, the lender may sell it to Fannie Mae or Freddie Mac. And in the past, they specifically said that the lender had to use a FICO 2 score in order for them to buy the loan, and they had to meet certain criteria with that score. That score is about 25 years old, so it's been around a long time and it's kind of outdated. And really, we think in a lot of ways, because it was so outdated, was restricting people's access to be able to qualify for them, because it wasn't looking at credit in relation to how the market is today. And recently, they announced that they would begin to accept Vantage Score 4.0 as well as FICO 10 and a FICO score called FICO 10T that looks at trended data, which is really interesting because it's not just a snapshot. So they're going to take newer scores and be able to use those and from more than one source. So we think it's going to probably create more opportunity, because those scores being modern will be able to better predict lending risk, and so help people qualify that perhaps couldn't in the past. It will take a bit of time for them to become active. The lenders want to test them. They want to make sure they're working like they think they will. But it's really a big shift in the marketplace, because for the first time in my career, and I've been with Experian more than 28 years now, that mortgage lenders can use new scores. And I think that's going to potentially make a big change in the market.
And so the ability to, so now, as you're saying, before, when it comes to credit, it was only one scoring model, FICO, that was considered in by mortgage lenders. Now it's more than FICO, Vantage, and others. Why is that important? If you could repeat for us, why is that important for home buyers?
Yeah, well, there are, FICO is certainly well known, a very good company. Their scores are really good. It really came to the fact that the mortgage marketplace was sort of stuck in the past in some ways, using that older model. And now they've said we're going to modernize. And like so many things, credit scores still work kind of the same way. But if you think about cars and how they've changed since, say, 1995, and the amenities they have, the way they function, they work better, they get better gas mileage. With scores, they've improved to the point that they're able to better predict risk. They're able to really look at people who perhaps wouldn't have qualified in the past and say, we're looking at new kinds of information. We're looking at new kinds of data. We talk about Experian Boost, and that was we didn't allow that into mortgage decisions because a FICO 2 score would respond in a way that wasn't appropriate, that would see it as a risk when it should be a benefit. Now that information, your cell phone payments, your utility payments, streaming services, your rent, positive rent payments may be able to be included in the future in those applications and in those scores, so you could help yourself improve those mortgage scores and be able perhaps to be able to qualify. So they'll look at more kinds of information. They'll look at things differently in relation to today's market, the way people are managing credit, and potentially people who were on the edges and couldn't qualify may going into the future. That's the hope.
Denise, from your vantage point, how are the changes with the federal student loan? This is one of the questions that came in. Now that the federal student loans are active again, how much of a blow will it be to potential home buyers who don't resume their loan payments? And if you could just kind of start with the student loan piece and just in general, how it's affecting home buyers.
Sure. So yes, now that we are back into repayment, that is a part of your debt to income ratio. Now that you may still be deferred, but we have to consider a payment for you because you will have a payment eventually, and we want to make sure that you're not going into payment shock once that happens. So what happens at this point is there is a calculation that the lenders will use to assess a payment, and it can be as low as 0.5% of the outstanding balance or up to 1% of the outstanding balance. So even though you're not in repayment status just yet, we want to calculate, or the lenders require that we calculate a monthly payment so that when you start to repay, you won't have a big payment shock.
Excellent, excellent. And so going to this question, now that federal student loans are active again, what happens if a person doesn't resume their loan payments immediately?
I think that we will have problems with going into default if we don't make those payments. You can also get an income-based repayment plan, and we can use, or the lenders can use, that monthly payment instead of the 0.5% or the 1% if you have high student loan debt. So we would encourage you to make those payments, and so that it doesn't negatively affect your credit.
What is the best credit score or a safe credit score that you suggest our listeners get to if they want to qualify for a home loan?
So credit score requirements do vary, but a safe place to be is at the 640 range, and that is going to be 640 mid credit score. So of the three bureaus, it's very rare that we see that all of the scores are the exact same. And so we take the middle of the three credit scores as your representative score.
Awesome, awesome, awesome. And so if someone, well, going back to the median credit score, so if we're looking at the tri-merge credit report and someone has a TransUnion is one score, Experian is another score, Equifax is another score, whatever the middle of those three scores, that's
Three
the one
scores.
that you all use. Okay, excellent,
Yes.
excellent. What are steps that people should take to reduce their debt before applying to a mortgage?
So one of the things we help with is to establish a budget, because you'd be surprised of the things that you may spend your money on. And what we do is go through your bank statements with you to determine what are needs and what are wants. And as any goal that you're trying to set out, there may be some sacrifice that you have to make. And so we try to help you to determine what some of those wants are that we might be able to do without while preparing, and still maintaining the needs. So we want to take a look at it and have that hard conversation sometimes to see what we can change on spending habits, and maybe hopefully find more additional income that can be used towards savings.
Rod, buy now, pay later. I know that's a thing. People are looking at Klarna, and all these other kind of things. What is the pro and the con, or let's just say the realities, I should say, of using buy now, pay later services?
Yeah, so BNPL, huge topic lately. Buy now, pay later, you see it as buy in for or pay in for, or you'll see when you're online or in a store, you can buy this in 4 equal payments. They call it buy now, pay later. It's if there's people out there at my age, you'll remember layaway. It's kind of layaway without the layaway part. So it's a loan, and it's a small dollar short-term loan, typically paid back in 30 to 45 days. So In the past, they've not been part of credit reports. Recently, Affirm, one of the big buy now, pay later providers, has started to report their information to Experian. As we grow, we'll start sharing that information with lenders. Right now, we don't share buy now, pay later information with lenders. It would only appear on your credit report, your personal credit report when you get it. But in the future, it will be shared. So if you are making those payments on time, it's going to be beneficial to you. If you're not, it could be could hurt your credit scores. We also, at this point, when you see an inquiry on your credit report for buy now, pay later, we are not yet sharing those with lenders either. But when we reach that point, we're going to share buy now, pay later inquiries with the lender, but we will not include it in credit score calculations. So it won't affect credit scores, but the inquiry could affect a lending decision because they'll be able to consider that buy now, pay later debt if they're doing a manual review, which could affect mortgages as well. The key is that buy now, pay laters usually are small amounts, but there's something called debt stacking, and that's when people get into trouble. They'll take out a bunch of buy now, pay later loans, so that one $25 payment for a pair of shoes turns into 5 or 6 or 8, and suddenly you have several $100s a month that you're paying buy now, pay later, and then that does affect your ability to pay other debts. So that's the concern that lenders have.
What are the more serious type of credit issues that can kind of stall you from qualifying for a home loan, and what are just some quick suggestions you would give to overcome?
So all of those things are very, very serious. But I think the most serious would be a bankruptcy. But what happens most times are late payments. The late payments may not seem like much because I think a lot of people feel as if, I may pay it late or may skip a month and pay them both next month. Those hurt you so much because the late payment can reduce your credit score very quickly. And you have more people falling into that trap, I think, than you really do in the bankruptcies. But late payments, partial payments, not making payments at all, those are the things that can hurt you. And those are the things that are, I think a lot of people believe that as long as I catch up, I'll be okay. But that's absolutely not true. So.
Excellent, excellent. And going into your previous point about on-time payment, or on the other side of the coin, late payment. Late payment is really the kind of silent killer, if you will, of one's credit health.
That's a good way to put it. It really is. I think a lot of people feel as long as I'm not in the bankruptcy stage, that I'm okay. But those late payments will have a negative effect on your credit score. And there is no real such thing as just catching up next month. Lenders want to see how you make your payments, want to see that you manage your debt properly, so that they can feel comfortable that when they loan you hundreds of thousands of dollars, that you will manage that debt properly as well.
Excellent, excellent. And before we bring on Mike to talk about the tool and how that can be used to help to improve credit, Rod, talk to us about medical debts and how that can affect your credit score.
Yeah, so medical debt has changed over the years. We've actually, used to be a fairly common issue. Medical debts are huge debts, obviously. The credit bureaus have taken most of the medical debts off of the credit reports. We only include medical debts that are more than $500 now, and we only include them after they've been in collections for at least a year. So they don't just appear right away. We want to make sure that they aren't the result of a billing error or an insurance dispute, something like that, that they're actually still owed. And if you pay them off or get them below $500, we'll take them off of the report. So that helps in resolving some of that problem. Recently, the CFPB made an announcement, the regulatory agency, that they were changing their rule or withdrawing the rule that would have removed all medical debts. So there's been some concern about what's going to happen. Not sure yet, but I don't think they're coming back in the way that that's not changed. There's been no indication in our industry. We actually proactively had already removed most of them and put these policies in place before there was any regulatory action. I don't see us changing that. I'd be pretty surprised if we did. So whether the rest will come off, I don't know. We've taken off about 70% of them.
Awesome, awesome, awesome. So medical debt is not a stopping point either, but it is something that does need to be addressed. But you all are, Rod and Denise, you all are giving a lot of good news tonight. So that is great. And so we have 2 questions coming in the chat. Rod, this is for you. How long does it take to overcome late payments before getting on track to purchase your home?
Well, and here's the answer to every question about credit. It depends. So depends on the individual's credit history. Everybody's unique. About 220 million people with credit reports, but generally, a missed payment will remain for 7 years from the date of the missed payment. And as long as it's there, it may have some small effect. The further in the past it occurred, the less effect it has. So if you can catch up, as Denise mentioned, if you can bring the account current and keep it current, that will have less effect. If you just have one late payment, never had any other problems, talk to your lender. They might be willing to take it off. And so it can go away right away. If you've had sort of a history, it gets harder. But generally, it's going to affect it for a significant period of time. The more late payments you have, the longer it's going to be. That's the challenge.
And Denise, with our, I don't want to say collection, but with our group of lender partners, what are you saying in terms of some of the credit parameters, allowances that they are permitting?
So I am seeing that when we have charge-offs, that the lenders aren't requiring you to bring those charge-offs clear, because typically the bank or the lender who has charged off the account has already written that off on their books. So we're not seeing that they are requiring charge-offs to be taken care of. With that said, we don't want to get into that habit of charge-offs, because this could change. As you see, things are changing rapidly and things are changing almost daily in this field. But we do find that lenders are a little lenient on those kind of things. And then there are different types of loan programs, like an FHA loan, where there is a little more leniency on credit in an FHA, or should I say government loan program. So there's a lot of hope. There's a lot of options. And what we do is we find out those underwriting parameters from each and every lender that we work with, and we find the product and the company to tailor fit our clients.
Mike, so a good question came in. How can you get things removed from your credit report? And I'm going to answer that. If you get things removed from your credit report, does it really help you or hurt you from qualifying for a loan? Rod and Denise, either one of you all can take that, because I see a level of excitement on both of your faces for that question.
Well, it depends. So it's one of those things that, if the information's accurate, it's not going to come off right away. You can dispute information. We encourage people to do that. If you find something you think is inaccurate, you should dispute it. It's free. Doesn't hurt credit scores. With Experian, just go to experian.com/dispute and follow the instructions. Would give you a free report to do that. But if it's accurate, it's probably going to remain. So you can't pay people just to take it off, even though they may promise you to do that. The Federal Trade Commission has said that you can't remove accurate negative information outside of timeframes. Now, the older it gets, it may be coming off. So late payments stay for 7 years. So it may come off, may be ready to come off. The one thing that has changed is that if you have a collection account and you pay that collection, it might be removed from the report, for example, with medical collections. The other thing is that credit scores today, the new ones, so the ones that may be used in mortgage lending soon, will ignore a paid collection. So if you pay that collection off, it wouldn't be included in the score. That could help your score right away. And so it could help you qualify in the future for the mortgage. FICO 2, the current model, doesn't do that. That's been part of the challenge. It doesn't react the same way. So the new ones as it changes could be really helpful.
And oh, go ahead, Denise, were you going to say something?
So I wanted to piggyback on what Rod said about some of these pay per service programs. I've seen these numbers to be astronomical, and a lot of promises being made that they really can't effectively do after you've made that payment to them, and maybe they will petition to have things removed off of your report. But if it is inaccurate, it will return. So
if I'm hearing you all correct, Rod and Denise, there's no shortcuts, there's no get out free cards, but there are plans, action steps, and credible ways through the help of Experian CreditCenterᶀᴦ, through the help of the personalized guidance through HomeFree-USA for people to get back on track.
yes.
Absolutely.
And you can save that money and use it towards a legitimate purpose of paying down or paying off some debt.
Yeah. Hey, everyone. Again, my name is Mike Bradford Calhoun. Milan, thank you for this opportunity to share today. So I'm going to share my screen and get us started here. So with the credit tool, just like Rod said several times, it all depends. But one of the things that I love about this program is it helps you see everything in one single space. And so and I know there is a slide that Milan has prepared later on that will give you a QR code and the link to go into the Experian Credit Center. So first, I'm just going to show you what it would look like to enroll. Here you would go to enroll now. And when you click enroll now, it's just like signing up for mostly anything, some basic personal information, some account information that you'll need to provide, and just some security questions. Now, this is a demo site, so you are not seeing Mike's personal score. This is a demo site that we're offering to show you all what the tool fully looks like. And I want to emphasize it's a great tool and it's a reputable tool that we are offering through HomeFree-USA. So let's log in. All right, so when you first come into the tool, it will have some of your personal information, a personal greeting for you. Welcome back, Donald. And it's going to give you some alerts about your credit score. Now, this is the home page that you'll see anytime you log into the portal. And it'll tell you a little information about what your FICO score means and what it does. When lenders review your credit score, they're evaluating how likely you are to make timely mortgage payments if they approve you for a home loan. So Donald here, he has a pretty good score of around 735, and we want to see like, hey, maybe he wants a different type of program, or maybe this is something he's already been using and has got his score to a great place. And some of the things that you'll see in here, we'll go through the top here. So you've got the dashboard, which is this first screen where you can set your credit score, and we'll go here in a second. But also here on the side are some good recommendations for, hey, what your credit report looks like and what your credit score looks like. What is considered a good credit score? One of the things that they mentioned earlier, your credit score is never static, so you can't fix it into one place at any certain time. However, it's like adult homework. It's one of those things that's always due, and there's always something else you have to do with it. So let's tour this site for a little bit. The second page here is your actual credit report. So when you come in here, you'll be able to access all of your information. This one was updated as of July 21st of this month. You can even print this off and share it with your housing counselor as you go through the program and you're working with them. So it'll have your summary, your personal information, your consumer statements, credit inquiries that you may have, the different types of credit, so revolving credit accounts, different lines of credit that you may have. Donald doesn't have any existing real estate because, hey, like Milan stated, this can not only help those who are looking to become home buyers, but let's say you have a higher interest rate and you finally gotten to a place where you want to lower your monthly payments. This is a great tool for that as well. Any installment accounts that you have, all of the open accounts that you have, and you can see there are quite a few here. It'll also show, hey, how many times you've been on time within the last 24 months, what your past dues look like, so on and so forth. Any collection accounts you may have, other accounts, derogatory information. Let's see, listen, it looks like he's got one account that is closed, any public records such as a bankruptcy, and your creditor contact information about, hey, who do you need to contact when it comes to those accounts that provided that credit score? Now, this is what your credit report looks like. It'll have all that information. This is where you can view it, print it out, throw it into AI and say like, hey, is there anything that looks crazy with my credit report? Then you can also come over here to the next page, which will show you the actual FICO score. And for this specific tool, it will only show you your FICO 2 score model, which is the industry standard. As Rod stated earlier, right now, because the industry is adjusting to the newer FICO scores, this is still the industry standard for right now. But in general, all of the information that will be provided will help you no matter what score is used in the future. So your score over time at a 735, that's pretty good. Let's look at his score over time. You can see the history of his score, what it was like a couple of months ago, and he's maintained that. But then, hey, let's say, hey, maybe the score is, let's say if this was 100 points lower, what would Donald be able to do? So the next step in the process of using this tool is to actually set your target score. So let's go ahead and set a goal for Donald. All right, you're looking to buy a new home, secure a better mortgage rate, or just overall improve your credit health. You can set a target score here. So let's say, all right, he's at 735 today. The max score he can get on this program is an 844. Now, let's say we want to get him to, let's say, a 760. You'll come in here. It's a sliding tool. You can use your mouse. And please note, I do believe this is better. The best usage you will get is on a laptop computer. You'll be able to access this from a mobile device, but it won't be an actual mobile app. So next, once I hit next on that calculator, it's going to tell me which score what time frames I can use. So it looks like, hey, to get to that score, I can't really use a time frame. So let's lower that a little bit. Let's say we want to get him to a 750. He's at a 735 today. All right, so he has options to get him to a 750 credit score. Let's say, hey, it's going to give him a little bit of education. A target score for FICO 2 is not met within cannot be met within 3 months, but could be met within 12 months. So this will give you different options. And so no matter where your credit score is, it'll give you different options to like, hey, here's the best plan for you in terms of what your target score is from where you are today and how long it feasibly can take you to reach that. So what does he need to do in 12 months to go from a 735 to a 750? Number one, reduce his total revolving open account balances by a little over $3,000 a month by $52 each month for 12 months. Pay all your bills on time, particularly the ones for like your credit cards, mortgages, existing mortgages, any of your major bills. Stay current on those payments so that your most frequent delinquency ages to 4 years and 2 months. That's to Rod's point. If you keep up with those accounts, if you're just late one time, it does happen. It happens to everyone. But if you can maintain your payments following that delinquency, it'll make that hurt your score less. Allow for your average length of established history to age to 12 years and 6 months. So Donald's been in the game for a little bit. And the great thing about credit scores is the older they get, the older you have accounts on your account that are in good standing and you're maintaining those lower balances, it's going to help your score. Continue to make your monthly installment loan payments on time to reduce the total installment balances. So installment loans, such as anything he has on this account, such as a personal loan, that's going to be helped. And wait to apply for new credit cards. Newer credit, such as with inquiries and just having newer credit, a lot of the credit agencies, they want to see that you are gaining good stamina with what you already have on your plate. So the great thing about this tool is not going to tell you need to get something new to improve your score. It's going to help you with what you have on your plate today to see how you need to be better for your tomorrow. And so what does that score look like? It's going to show you, all right, save. And now that's the score planner. Now here's what you're going to do. It's going to tell you, all right, it's going to take 12 months. Your goal is 750. Here's where you are today. And as time goes on, it's going to keep you up to date with every time you log in, you're going to get information about like, hey, what are those alerts that are going on? What's going on with my credit score? What's going on with my credit report? Let's go back and review those together. So it looks like he's gotten a new credit report. Looks like something hit back in May. And this is what you want to look at, making sure that you're keeping your balances low and understanding everything and seeing everything in one place. So keeping update with those alerts, and you will be provided with those. And the planner will help you keep track and say like, hey, where am I at today? And how do I get to where I want to get to 12 months from now? And it'll tell you, hey, you're off and running. Keep up with this plan. It'll tell you those general facts. But then also, maybe you're just not sure of how you're going to get there or what you need to do. That's another great thing that you can do. We also have a simulator. And for this FICO 2 simulator, there are about 8 different scenarios that can help you improve your credit score. So in looking at, hey, here's your current score, what happens if I were to do this? So let's say make regular credit card payments of $130 a month for 24 months. You can go in here and it'll say, hey, over the course of 2 years, that alone, all other things remaining constant, you're doing everything else as it is, that can improve your score in 24 months to a 750. Let's look at another one. Let's say he gets a new credit card, and say that limit is $5,000 for that new credit card. That's actually going to bring his score down because it's a newer credit card and newer credit line. And there are several others in here, like paying your bills on time. Let's say pay your bills on time for, let's say, 20 months. That can also take up your score to about 745. So just doing those basic things, this will show you examples of what you can do. It's not a guarantee, but that's what the planner is for, to walk you through step by step of what you need to do. And the last thing you can look at here is just our education center here. It'll provide you different things about, like, hey, what is a hard inquiry? Say I do, not I debt, talking about marriage when it comes to finances and credit, employment, opening a business, divorce, and retirement. What is credit? What is revolving credit? What are charge cards? What are service cards? What's installment credit? All of these things can be found in this tool. Now, I have talked at litem about everything in the tool. And so I will stop sharing my screen at this. I think I stopped sharing my screen. What questions have come up?
So one, Mike, thank you so much for sharing this credit tool. For everyone on the line here, do know that this is an opportunity for you to monitor your credit. And Mike, let me not speak for the tool. You are the expert at it. In summary, what are 3 big benefits of you for using this tool?
3 big benefits of using this tool. The first big one, and I mentioned it a couple of times, is number 1, seeing everything in one place. Sometimes I found this with even in my personal finances, my personal credit journey, it was not knowing where everything was and having all these different apps. Listen, this is one place where you can look at your credit score, your credit report, what you need to do. Looking at everything in one centralized location is a big benefit. Number 2 is that, hey, it's going to walk you through step by step of what you need to do for your personal financial credit journey and credit health. And number 3, the big thing, it's free for a year. So there's no cost to you. It's something that we are offering as a partnership with HomeFree-USA. So those are the big 3 things, and take advantage of it while it's here. Trust me, I bought my first home when I was 25, and I'm 30 now, so 5 years ago. And one of the big things about that, Experian, even then, just with what they offered at that time, was very helpful and instrumental in me being able to do that. So seeing this be able to be utilized for different folks for free, it's a great opportunity, or at no cost. It's just a great opportunity, and I encourage everyone to take advantage of that.
And so what would you say to those on the line that may be saying, well, I already use other type of credit tools that are out there. There are a lot of different credit tools that are out there. What would you say, what separates Experian and this credit tool?
This credit tool, number 1, this is number 1. We were very specific. I used to work within Experian, in the housing product team. And so we were very diligent and specific about utilizing the FICO 2 score because that is the industry standard. Now, as Rob mentioned earlier, there are a lot of different scores out there. Most credit sites you'll see use variations of the Vantage or FICO score, but FICO 2, as it stands today, is the industry standard for the mortgage industry. So that's going to be the most direct score that most mortgage lenders use for the near future. And so that is very specific. We were intentional about doing that because we just don't want you to have general information. No, we want you to know exactly what you need to do and how you need to go about doing that to secure your home ownership in the future.
Awesome, awesome, awesome. So there are a lot of credit tools out there. The good thing is with Experian, as Mike has just said, it is not only a credit monitoring tool, it's also a credit education tool, and it gives a score that the mortgage industry is going to take seriously. Talk to us and remind us how the simulator helps us to determine what debt we need to pay off to get to X desired score.
Yeah. So let me open it back up really quick. So when it comes to the simulator will tell you a couple of things. And I'm opening it back up because it is very time sensitive. Give me 1 second here. The thing about it is it will make the simulator number one will give you a good recommendation about, hey, which one is going to give you the, lack of a better term, best bang for your buck. So in this situation, hey, 735, this is recommending that the best action step that Donald can take is to continue making regular credit card payments. So let's say he makes $250 over the course of, let's see, he pays $250 worth of payments. He pays $250 every single month. So over the course of 12 months, that improves the score by 15 points. But there are other scenarios. And again, as Rod said, it all depends. So when it comes to the paying all your bills on time, the age of your credit report, that's why you have to be very careful about applying for new credit cards or any type of new credit, because that can hurt your score because they like to see that lengthy history. And what taking out, even let's say, hey, you take out a $300,000 mortgage. What does that do? What would that do to your score? It would knock you down 5 points. So all of those things they depend on where you are. Everyone's credit history is very different, but this can help you define, hey, what's the best course of action for me, and what does that plan need to look like when we go into the actual planner?
Excellent, excellent. So everyone, thank you so very much for joining us. We have just given some highlights on ways that you can overcome credit issues and increase your score. Of course, the Experian Credit Center is an opportunity and a tool, a proven tool by one of our credit bureaus, but also, as Rod said, a company that's really committed to improving your financial life.